Hello everyone. Today our group will present the topic, the impact of US monetary policy stagnating on the Malaysian ringgit, exchange rate pressure, inflation risks, and BNM policy challenges. After the COVID-19 pandemic, the global economy faced a strong inflation pressure. This was caused by supply chain problems, higher commodity prices, and rising food and energy costs. To control inflation, the United States Federal Reserve started to raising interest rates rapidly from 2022. This is important for Malaysia because the US dollar plays a major role in global financing. When US interest rates increased, US dollar assets become more attractive to investors. As a result, capital moved towards the United States, the US dollar became stronger, and many emerging market currencies, including the Malaysian ringgit, faced depression pressures. So our research focused on three main objectives. First, we examined the movement of the US dollar and ringgit exchange rate during the US tightening cycle. Second, we compared the US Federal Fund rate with Malaysia's overnight policy rate. Third, we analyzed how ringgit depressions created inflation risk and policy challenges for banking negro Malaysia. This study is important because BNM had to balance three goals: maintaining exchange rate stability, controlling the inflation, and supporting the Malaysia economic growth.
Now let's look at our theoretical framework and the literature review. First, we use uncovered interest parity. When the US raised the interest rates while Malaysia kept the rates low, the interest rate gap became larger. Because of this, money flowed out of Malaysia to buy US dollars. This put heavy pressure on the ringgit and made it weaker. Second, we use the exchange rate pass through. Malaysia imports a lot of food and materials. When the ringgit becomes weaker, these imports become more expensive. This causes high inflation in our domestic market. And third, this shows that the impossible Shunte dilemma. Bank Negara Malaysia faces a difficult choice. Raising rates can support the currency, but it hurts economic growth. According to the literature, such as Ree and Sam, US policy strongly impacts emerging markets. Therefore, Lim and Go suggest that Malaysia should use a hybrid policy mix, using both interest rates and foreign exchange interventions to protect the economy. In short, theory shows that U.S. tightening brings big challenges to Malaysia. Next, my teammate will show you our data and findings. Thank you.
Next, I will show the key findings based on our 2020 to 2025 monthly data set. First, the interest rate comparison between the US and Malaysia. Before 2022, both policy rates stayed at low levels. Starting in 2022, the Fed launched aggressive tightening, lifting the federal funds rate from 0.875% to a peg of 5.33 in July 2023, a total hit of over 500 basis points. By contrast, BNM raised the OPR far more moderately, only from 1.75% to 3%. This policy divergence sharply widened the US Malaysia interest rate gap from 2022 to 2024. Next, the dollars and the ringgit exchange rate trend from 2020 to 2021 with low US interest rates. The ringgit remained stable at an average of 4.17 once the Fed began hiking. The ringgit entered the sustained depreciation, the average rate rose to 4.51 in 2022 to 2024 and peaked around the 4.77 in late 2024. This aligns with uncovered interest parity. A wider rate gap drives capital toward higher yield U.S. assets, putting downward pressure on the ringgit. Then we look at the inflation and the transmission mechanism. And the slide shows the chain works as follows. Fed rate hikes to capital outflows, to weaker ringgit, to higher import costs, to domestic inflation pressure. Malaysia's inflation peaked at 4.7% in August 2022, with ringgit depreciation contributing about 30 to 40% of total inflation in that period. Yet a key finding is that the exchange rate was not only driver, even as the ringgit kept working. Average inflation caught to 2.59% in 2023 to 2024, pulled down by easing global commodity prices, supply chain normalization, and domestic price subsidies. Finally, BNM's policy dilemma. BNM faced the classical policy trilemma. Aggressive rate hikes would hard post-pandemic domestic growth, but keeping rates too low would worsen currency depreciation. It therefore choosing gradual OPR adjustments, supplemented by foreign exchange interventions to stabilize the ringgit without derailing the economy. To wrap up our three core findings. First, U.S. material tightening is the main driver of ringgit depreciation, transmitted mainly through the interest rate differentiation. The second, ringgit weakness added important inflation pressure, but was not the dominant driver of overall inflation. Facing the trilemma, BNM balanced multiple targets with a mixed, moderate policy pocket. This on my part. Let's move on to the next part.
For our project, I'm responsible for the data collection and the data description part. To make our study reliable, we collected monthly data for 6 years, from January 2020 to December 2025. This timeline is perfect because it covers all major economic changes, from COVID-19 to recent policy shifts. We have gathered 5 core variables from highly credible domestic and international sources. First, Malaysia overnight policy rate is retrieved directly from Bank Negro Malaysia. Second, the monthly inflation rate is sourced from the Department of Statistics Malaysia. Finally, both the exchange rate and the U.S. funds rate are from the FRED database. All dataset has been perfectly aligned and clean. Based on this, I have created a line chart and bar chart.
Good morning, everyone. Now I will present Section 6 discussion. Our findings shows that when the U.S. Federal Reserve raised interest rates after 2022, investors shifted their capital to U.S. dollar sides because they offered higher returns. As a result, the U.S. dollar became stronger, while the Malaysian ringgit depreciated. A weaker ringgit increased the cost of important goods such as food, fuel, and industrial materials, creating important inflation pressure. However, inflation was also influenced by other factors, including global commodity price and government policies. The main challenges for Bank Negara Malaysia was finding the right balance. If BNM raised interest rates too much, it could slow consumption, investment, and economic growth. But if rates remain too low, the ringgit would continue to weaken and inflation pressure could increase. Therefore, BNM adopted a gradual and flexible
policy approach, combining moderate OPR increasing with foreign exchange intervention to maintain exchange rate sustainability while supporting economic growth. Thank you.
In conclusion, our study showed that the U.S. monetary policy technically had a clear impact on the Malaysian ringgit. When the Federal Reserve raised interest rates quickly from 2022, the return on US dollar assets became higher. This attracted global capital into the United States and increased demand for the US dollar. As a result, the Malaysian ringgit came under depression pressures. Our finding also showed that the Bank Negro Malaysia responded by increasing the overnight policy rate. However, Malaysia's rate hikes were smaller than the Federal rate hikes. The Federal funds rate increased much more strongly, while Malaysia OPR ratios more gradually. The widened the interest rate gap between the United States and Malaysia and become one of the main reasons for weaker ringgit during the 2022 to 2024. A weaker ringgit also increased inflation risk because important goods, food, fuel, and the productions inputs become more expensive. However, inflation in Malaysia was not caused by exchange rate alone. Other factors such as global commodity price, supply chain conditions, subsidies, and domestic price controls also affected inflation. Therefore, BNM faced a difficult policy dilemma. If BNM raised interest rate too much, it could hurt consumption, investment, and economic growth. But if interest rate stayed too low, the ringgit could weaken further and important inflation could increase. Overall, Malaysia needs a flexible and data-dependent policy approach. BNM should continue using the careful monetary policies, foreign exchange rate invitations, and microprudential tools to manage further external shocks. Thank you for listening.